Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello, everyone. Welcome to the Through the Noise podcast. It has been an eventful week across global markets, with inflation data and central bank signals shaping sentiments. Today, I'm joined by Ray Heung, our senior investment strategist, and together we'll discuss the Fed's outlook, Europe's growth inflation mix, some of the currency opportunities, and also positioning across global equities in an uncertain current macro environment. Hi, Ray. So, what do we make of the latest PCE report, and do you think it will impact the hawkishness of the Fed?
Hey, thanks, Michelle, for having me. We think the number, which is in line with market expectations, validates the impact of higher energy prices, but it does not spur a hawkish Fed pivot. If you look at the 3.8% year-on-year headline PCE reading, this is actually expectedly driven by the Middle East conflict and higher energy prices. However, if you look at the details, the spillover beyond energy-related costs remain limited. Now, recall that the Fed held policy rates in April unchanged, and the FOMC members actually hinted that it will wait for more data before the next move. So together with the medium-term inflation expectation, which has remained relatively contained, we think the policymakers can frame this print as consistent with their adverse scenario rather than a crisis requiring immediate action. The market implied policy rate has also yet to move to reflect a definite height by December 2026. And that's actually reinforcing the Fed wait-and-see approach in our view. And we believe the Fed will retain the optionality in the near term. That means that it can maintain its pause posture while signaling readiness to act, and without being forced into any emergency response in the meantime. Our base case scenario remains that the oil prices will gradually go lower as the conflict in the Middle East is expected to be resolved over a few more weeks. And together with an anticipated weaker U.S. job market, our base case remains for the Fed to cut once before the year end in 2026. In here, I also want to share a little bit interesting observation about the U.S. interest rates. If you look at the past decade, a 70 basis point or more spike in the U.S. 10-year government bond yield over a 3-month period was usually followed by a pullback in the yield over the next 3 months. And this actually just happened before this PCE print and continued despite the number in the PCE print can be argued as a high print.
Got it. So apart from the US, do you think that the euro area is moving towards stagflation? And is the ECB June rate hike already priced into bond yields? And what are the investment implications?
Yeah, I think the recent euro area consumer inflation data points to a stagflationary impulse. It's not a full stagflationary regime, though. We obviously saw a sharp April energy price increase, and that reflects an external supply shock in our view, rather than a broad-based domestic inflation. As we actually witnessed the core inflation ease to 2.2% for that region. Meanwhile, economic growth momentum has weakened in Q1 2026, with the GDP rose only 0.1% quarter-on-quarter. And the European Commission has cut its 2026 GDP forecast. So the mix of a softer growth and energy-driven inflation does leave the ECB in a difficult position, but that does not signal an entrenched wage price increase dynamics. And so we believe there is limited upside in Bunds, in the Bund yields in the euro area. Markets have already priced in a fairly hawkish ECB path, and including a 25 basis point hike as early as June and another by Q3 2026. So this is actually ahead of our expectations, where we're only expecting one hike in June. Now, we view the hurdle for a further meaningful spike in bonds yields is relatively high, unless the ECB delivers a distinctly hawkish message via forward guidance or balance sheet policy. And moreover, a June hike alone is unlikely to be enough to drive sustained currency upside. So with this in mind, we turn a little bit more positive on the longer tenor part of the Bund and expect them to outperform their counterparts in the US and Japan. In addition, euro-denominated credit spread could widen in a weakening growth environment. So for credit, we prefer high-quality defensive credit quality exposure to weather recessionary impulse. In particular, we're talking about the European financials, given their fairly solid fundamentals.
So, what about the outlook on New Zealand dollar? So, we know that the latest RBNZ policy meeting has been held. So, what's our view overall?
Yeah, I think we are still overall bullish on the Kiwi versus dollar, with the upside potential supported by a hawkish RBNZ and market expectations favoring further rate hikes from here. We currently view the pair's immediate resistance is about 60 cents to the dollar. We think the RBNZ has adopted a fairly hawkish tone. It kept the policy rate unchanged at 2 and 25% in a split decision, but it has also signaled its intention to implement at least 2 more 25 basis point hikes by the year end of 2026. So to us, this is clear commitment to tightening monetary policy, and coupled with the market pricings that now reflects a total of around 110 basis point in rates increase, with a terminal rate forecast to be around 3.25% by 2027, this provides a fairly strong support to the New Zealand dollar. The RBNZ is firmly focused on addressing inflation risk in our view, particularly those driven by rising fuel prices, even as it recognizes the potential downside for consumer spending and also the business sentiment. And the projection from the central bank also suggests a widening output gap and persistently elevated unemployment. Yet, the policy rate is poised to rise further despite a subdued labor market. And this shows the RBNZ prioritize price stability over any short-term economic softness in our view.
Got it. So, lastly, moving back to China, currently, what is our view on China equities after the recent underperformance and also some of the regulatory changes?
Yeah, I think in that sense, we remain overweight on China equity within the Asia ex Japan area, with Hang Seng Technology Index likely supported by long-term structural tailwinds. We think the China regulatory crackdown on cross-border trading has raised capital flow restriction concerns, but the market impact has been relatively modest. The scrutiny reflects the continued policy normalization, in our view, rather than a directional shift. Meanwhile, if you look at the steady southbound net inflows, that indicates strong mainland investor conviction in the Hong Kong listed equities. So our overweight on China equity is basically supported by this ongoing policy support and the market's relative insulation from the geopolitical and inflationary pressure outside. While the recent weakness in Hang Seng Tech reflects margin pressure from offshore-denominated internet and hardware platforms, we remain constructive longer term, and this is underpinned by policy, tailwinds, and ongoing technological innovations. New AI and semiconductor names in the Hang Seng Tech also help benefit from the AI infrastructure investment. Well, a little bit more on equity I would like to add, our diversification core. Despite the strong corporate earnings supports risk assets over the medium term, the uncertainty around the resumption of shipping through the Strait of Hormuz and the pockets of investor exuberance, especially in the semiconductor-related sector, stretch investor positioning, also call for more diversified allocation. And so we remain broadly diversified across region and equity, with a slight preference for US equities.
Got it. Thank you so much, Ray, for your valuable insights today. So that's all we have for today. Overall, in summary, we're still expecting the Fed to have one more cut by year end, while on the other hand, Europe faces mild stagflationary impulse with limited upsides in yields. So in Asia, we are staying overweight in China equities while maintaining a diversified equity positioning under an elevated macro and geopolitical uncertainties. So if you'd like to stay updated on the latest investment trends, please don't forget to like and subscribe. We'll be back next week for more market perspectives.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.